Good evening and welcome to tonight's market wrap. Let's dive straight into the numbers. Wall Street closed with a mixed picture tonight. The Nasdaq managed a slight gain of 0.2% to finish at 25,870 points, largely propped up by a massive 4.2% surge in Nvidia. But the S&P 500 slipped 0.28%, and the Dow Jones took a bigger hit, falling 1.09% to close at 52348. The VIX fear gauge jumped nearly 5% to 16.9, telling us investors are getting nervous. The 10-year Treasury yield also climbed to 4.57%, which puts pressure on growth stock valuations. Over in commodities, crude oil was the big story. WTI surged nearly 3% to settle at $74.59 a barrel, bringing its 7-day gain to over 8.5%. The catalyst? An API report showing a sharp drop in U.S. crude inventories, combined with the EIA raising its global demand forecast. Gold pulled back, losing 1.24% to trade around $4,088. The dollar index was basically flat at 101.07, but the offshore yuan weakened slightly to 6.8053, signaling continued capital outflow pressure from China. Bitcoin also fell nearly 2% to $62,330, confirming that risk assets are broadly under pressure. Let's walk through the global trading session. Asia started the day on the back foot. China's A shares fell across the board, with the Shanghai Composite down 0.48%, the Shenzhen Component losing 1.87%, and the Chinext Board dropping 1.7%. Growth stocks led the decline, setting a weak tone from the open. European data was unavailable, but given the higher Treasury yield open and a steady dollar, risk aversion likely persisted. When U.S. markets opened, technology stocks showed severe internal divergence. Nvidia's surge failed to lift the entire sector, while energy stocks followed crude oil higher and became the safe haven for the day. The market tried to recover into the close but lacked conviction. There was no clear inflection point today. The market is searching for balance between weakness in semiconductor equipment names like ASML and strength in Nvidia. The sentiment leader today was clearly crude oil and energy stocks. The laggards were consumer services, financials, industrials, and Chinese tech stocks. Looking back at this morning's outlook, we called for a weak and choppy session, which was broadly correct. Energy strength matched our expectation, and the decline in risk appetite was confirmed by the VIX move and weakness in Chinese stocks. But we missed one big thing. We did not fully anticipate the degree of divergence within technology. Nvidia's 4.2% gain in an otherwise quiet earnings period caught us off guard. And interestingly, the market seemed to ignore the risk of tighter U.S. technology export controls, treating Nvidia's rally as a stock-specific story rather than a sector-wide recovery. We also picked up a new signal today. Some compute infrastructure and materials names are starting to show signs of crowding. But the probability is only 55% and we need to see if this trend continues. Now let's look at the triple linkage. The dollar was flat but the yuan weakened, indicating continued capital outflow pressure from China. US and Chinese stocks were directionally aligned, both weak, confirming that when the external environment is unstable, Chinese markets are more vulnerable to domestic sentiment. The 10-year yield breaking above 4.55% weighed on growth stock valuations, explaining why most tech names struggled outside of Nvidia. Overall, these three indicators are sending a bearish, pointing to declining risk appetite and capital outflows from emerging markets. On the fund flow front, energy was the strongest sector for the second consecutive day, driven by inventory declines and supply-demand expectations. Defensive sectors like utilities and consumer staples held up relatively well. The weakest areas were technology growth stocks and Chinese ADRs, with the Chinext Board under particular pressure. Looking ahead to tomorrow, here are the key things to watch. For Asian markets, we expect the Chinext Board to open lower, with 60% probability, driven by higher Treasury yields weighing on growth valuations. Energy, as measured by WTI, is likely to trade steady to slightly stronger, with 55% probability. The inventory data catalyst has been priced in, but geopolitical risk premiums remain. The VIX is expected to stay elevated in a range between 16 and 18. The dollar-yuan pair may continue to grind higher, trading in the 6.80 to 6.81 range. From a trading perspective, our recommendation is to stay on the sidelines and wait for U.S. futures to confirm the direction. If Chinese and Hong Kong markets open lower, do not go long intraday. If the VIX futures are below 16.5 and Treasury yields fall back below 4.5% before the A-share open, a small long position in Chinese energy and coal stocks could be considered. But if the VIX is above 17, abandon any long attempts. If Nvidia falls back below $200, exit the entire AI hardware trade. And watch for these failure signals. If WTI crude breaks below $72 or the dollar index drops below 100.5, those would be important red flags. Let me wrap up with a bottom line. Today's market was characterized by structural divergence, with capital rotating out of growth and into energy and defensive sectors. Risk aversion is clearly rising. Our probability assessment for tomorrow is 25% up, 40% sideways, and 35% down. Investors should remain cautious, watch the sustainability of the energy rally, and monitor whether tech divergence widens or narrows. Until direction becomes clearer, protecting capital and waiting for confirmation is the prudent move.